Hi, my name is Anna Hess, your Patton University course instructor. Today we're going to be doing Unit 5 called Financial Institutions, Organization, and Performance. Let's start with the introduction. Do you remember opening your first bank account? Many people have one when they get to their first job or leave home for the first time. It comes at a time of your life when you're earning money that you need to keep in a stored, safe place, which is the main purpose of commercial banking. Commercial banks are types of banks you're most familiar with. They're places where you open a banking account and then go in, make deposits or withdrawals, and can also take out loans. However, commercial banks are also involved in the economy beyond serving the public. These banks are designed to make a profit so they can make investments and trades similar to other financial institutions. Commercial banks are a large part of the economy. Not everyone uses a commercial bank for their financial needs. There are other types of banking institutions called thrift institutions that also serve the public's banking needs. Thrift institutions began primarily for the purpose of reaching small savers, principally individuals and families, and helping this group of customers achieve home ownership, a better education, satisfactory preparement for retirement, and other personal financial goals. Over time, however, thrifts have diversified their services and attempted to reach out to a broader customer base, including both households and some business enterprises. Finally, the banking sector is also comprised of financial institutions that do not take deposits or hold funds in traditional sense. These non-depository institutions also provide ways for the public to store money, but the funds in these institutions are not easily accessible. This includes things like mutual funds, which are essentially a group of stocks that a person invests in, life insurance policies, and retirement funds, to name a few. Together, all three groups of banking options comprise a large aspect of the banking sector. For Objective 1, we're reading Chapter 12, Depository Institutions, Banks, and Bank Management. Banks are the most visible financial intermediaries in the economy. Most of us use the word bank to describe what people in the financial world call depository institutions. These are financial institutions that accept deposits from savers and make loans to borrowers. What distinguishes depository institutions from non-depository institutions is their primary source of funds, that is, the liability side of their balance sheets. Depository institutions include commercial banks, saving loans, and credit unions, the financial intermediaries most of us encounter in the course of our day-to-day lives. Banking is a business. Actually, it's a combination of businesses designed to deliver the services discussed in Chapter 11. One business provides the accounting and record-keeping services that track the balances in your account. Another grants you access to the payment system, allowing you to convert your small balances into cash or transfer them to someone else. Yet a third business pools the savings of many small depositors and uses them to make large loans to trustworthy borrowers. A fourth business offers customers diversification services, buying and selling financial instruments in the financial markets in an effort to make a profit. Banks trade in the financial markets not just as a service to their customers, but in an effort to earn a profit for their owners as well. The intent of banks, of course, is to profit from each of these lines of business. Our objective in this chapter is to see how they do it. Not all banks make a profit. While some banks are extremely large with hundreds of billions of dollars in loans and securities on their balance sheets, their access to funds is no guarantee of profitability. The risk that the banks may fail is a problem that not just for their owners and managers, but for the rest of us too. In the years from 2009 to 2015, nearly 500 U.S. banks failed outright, while more than 1,300 merged, reflecting the most severe financial crisis since the 1930s. We have emphasized repeatedly that financial and economic development go hand in hand. An economy that lacks the financial institutions to effectively channel resources from savers to investors is much less likely to thrive. This statement applies regardless of whether a country is rich or poor. The United States and Japan provide a striking example. By virtually any standard, both countries were well off. Yet, during the 1990s, U.S. banks made substantial profits, while Japanese banks suffered prodigious loss. At the same time, Japan's economy grew at a rate of just over 1%, while the U.S. economy grew at a rate well over 3%. The financial problems of Japanese banks played an important role in Japan's poor economic performance. Banks are important. When they are poorly managed, we all suffer. Similarly, the damage to the U.S. banks in the crisis of 2007 to 2009 helped make the U.S. recovery that began in 2009 the weakest since the Great Depression. In this chapter, we will examine the business of banking. We will see where depository institutions get their funds and what they do with them. That is, we will study the sources of banks' liabilities and learn how they manage their assets. And because banking is a risky business, we will examine the sources of risks that bankers face, as well as how those risks can be managed. The balance sheet of commercial banks. To focus our discussion of depository institutions, we will concentrate on what are called commercial banks. These institutions were established to provide banking services to businesses, allowing them to deposit funds safely and borrow them when necessary. Today, many commercial banks offer accounts and loans to individuals as well. To understand the business of commercial banking, we'll start by examining the commercial bank's balance sheet. Recall what a balance sheet is: a list of a household's firm or firm's assets and liabilities, the sources of its funds, liabilities, and the uses to which those funds are put, assets. A bank's balance sheet says that total bank assets equals the total bank liabilities plus bank capital. Banks obtain their funds from individual depositors and businesses, as well as by borrowing from other financial institutions and through the financial markets. They use these funds to make loans, purchase marketable securities, and hold cash. The difference between a bank's assets and liabilities is the bank's capital or net worth, the value of the bank to its owners. The bank's profits come both from service fees and from the difference between what the bank pays for its liabilities and the return it receives on its assets, a topic we'll return to later. Table 12.1 shows a consolidated balance sheet for all the commercial banks in the United States in December 2015. It reports the sum of all the items on the balance sheet of the 5,380 commercial banks that existed in the United States at the time. The government collects these statistics in the course of supervising and regulating the financial system to ensure bank safety and soundness. The numbers in the table are also related to the measures of money discussed in Chapter 2. Recall that the monetary aggregate, M2, includes deposits, which are liabilities of the banking system. Assets, uses of funds. Let's start with the asset side of the balance sheet. What banks do with the funds they raise. Table 12.1 shows that assets are divided into 4 broad categories: cash, securities, loans, and all other assets. Roughly 20% of assets, or $3.1 trillion, is held in the form of securities. 56%, $8.7 trillion, in the form of loans, and the remaining 24% in the form of cash and other assets. The last category includes mostly buildings and equipment, as well as collateral repossessed from borrowers who defaulted. In looking at consolidated figures like the ones in Table 12.1, we can get some sense of the scale by comparing them to nominal GDP. In the fourth quarter of 2015, U.S. nominal GDP was roughly $18.2 trillion, so total bank assets were equivalent to nearly 85% of 1 year's GDP. Cash items. Cash assets are of 3 types. The first and most important is reserves. Banks hold reserves because regulations require it and because prudent business practice dictates it. Reserves include the cash in the bank's vault and the currency in its ATM machines, called vault cash, as well as the bank's deposits at the Federal Reserve System. Cash is the most liquid of the bank's assets. The bank holds it to meet the customer's withdrawal requests. Cash items also include what are called cash items in a process of collection. When you deposit your paycheck into your checking account, several days may pass before your bank can collect the funds from your employer's bank. In the meantime, the uncollected funds are considered your bank's asset because the bank is expecting to receive them. Finally, cash includes the balances of the accounts that banks hold at other banks. In the same way that individuals have checking accounts at the local bank, small banks have deposit accounts at large banks, and those accounts are classified as cash. Over the years, the practice of holding such accounts has declined. so the total quantity of these correspondent bank deposits have shrunk. In December 2015, banks held more than 16% of their assets in cash, see Table 12.1. Up to the financial crisis of 2007 to 2009, that share was much smaller. In early 2007, it was about 3%, see Figure 12.1. Banks usually try to minimize their cash holdings because they typically earn less interest than loans or securities. However, the crisis forced them to change their strategy. A heightened possibility of bank runs, credit line takedowns, and borrower defaults prompted them to scramble for liquidity. And as market interest rates fell and the Federal Reserve began to pay interest on reserves, the important opportunity cost of holding cash plummeted. Securities. The second largest component of bank assets is marketable securities. While banks in many countries can hold stock, U.S. banks cannot, so this category of assets includes only bonds. Banks' bond holding are split between the U.S. government and agency securities, which account for 14.3% of their assets, in other securities, including state and local government bonds, which account for an additional 5.6%. Note that more than half of all securities are mortgage-backed, 10.8% of assets. Nevertheless, a sizable proportion of securities held by banks are very liquid. They can be sold quickly if the bank needs cash, which makes them a good backup for the bank's cash balances. For this reason, securities are sometimes referred to as secondary reserves. Figure 12.1 shows the trends in the composition of bank assets over the past 4 decades. Focusing on the line representing securities, we can see that the share of securities in bank assets has varied around 20% throughout the period. You're going to want to finish this reading on your own. After finishing the reading, you'll want to read an external page called A Credit Union That's All in the Family. Then there's a reading called Banks Cling to Bundles Holding Risk. Then there's an activity of flashcards to review. This concludes Objective 1. For Objective 2, we're going to start reading on page 331. Banking Industry Structure. Today's banking system bears little resemblance to the one Americans knew in 1960s or 1970. Then, people used their neighborhood banks. Not only did customers walk into the bank to conduct their business, but they knew the tellers and bank managers they saw there. Today, most of us don't go beyond the ATM in the lobby, and if we do, we probably don't recognize the bank's employees inside. Some of us do our banking via mobile phone or over the internet and never see the bank's bricks and mortar. Banks have been transformed so that location doesn't matter the way it once did. This change has occurred on both the national and international level. The best way to understand the structure of today's banking industry is to trace it back to its roots. That means looking at the legal history of banking. In this section, we'll learn that banking legislation is the reason we have so many banks in the United States. We'll look at the trend towards consolidation that has been steadily reducing the number of banks since the mid-1980s, and we'll briefly consider the effects of globalization. A short history of U.S. banking. If you want to start a bank, you can't just rent a space, put a sign up, and open the door. You need permission in the form of a bank charter. Until the Civil War, all bank charters were issued by state banking authorities. Because the authors of the U.S. Constitution feared a strong central government, in the early years of the Republic, the federal government was weak and sometimes ineffectual. State governments were often more powerful. Until 1863, in fact, there was no national currency. Instead, banks issued banknotes that circulated in much the way dollar bills do today. But while the state-chartered banks usually promised to redeem their banknotes in gold, they did so only if the bearer presented them at the bank. As the bearer traveled farther and farther from the bank, the values of the note fell. So, a note issued by a New York bank was worth less in Philadelphia than it is in New York. A $10 banknote issued by the Central Bank of Tennessee in 1853. Besides currency that did not hold its value from one place to another, the early American financial system was plagued by insufficient capital and fraud. Banks regularly failed, and when they did, their banknotes became worthless. As we saw in Chapter 2, given the license to print money, most people will print too much. With so many different banknotes circulating, telling the sound money from the unsound became inordinately confusing and insufficient. The whole point of printing money is to reduce information costs and facilitate trade. Still, reasonable people hesitated to accept banknotes issued by banks they weren't familiar with, so money was not widely accepted. In the end, the system just didn't work. Radical change came during the Civil War, when Congress passed the National Banking Act of 1863, initiating a gradual shift in power away from the states. Although the new law didn't eliminate state charter banks, it did impose a 10% tax on their issue of banknotes. At the same time, the act created a system of federally chartered banks, or national banks, which would be supervised by the Office of the Comptroller of the Currency, inside the U.S. Department of the Treasury. These new national banks could issue banknotes tax-free. Congress's intent was to put the state banks out of business by taking away their source of funds. While the act did get rid of state-issued banknotes, state banks devised other ways to raise funds, by creating demand deposits. This explains the origin of the dual banking system we have today, in which banks can choose whether to get their charters from the Comptroller of the Currency at the U.S. Treasury or from state officials. Roughly 3/4 of U.S. banks now have a state charter, and the rest have federal charter. The decision is related to a bank's profitability. State banking authorities have been more permissive than federal authorities in the types of operations they allow. Because greater flexibility in a bank's operations means a better chance at making a profit, state charters have been the overwhelming choice. Furthermore, if the Comptroller of the Currency won't allow a bank to engage in particular practice, the bank can always change its charter. This ability to switch back and forth between state and federal charters created what amounts to regulatory competition, which has hastened innovation in the financial industry. In the 1990s, changes in banking law required federal and state agencies to coordinate their oversight of financial intermediaries. But the globalization of the financial system, together with the bank's ability to move funds easily across international boundaries, means that today regulatory competition exists not so much between state and federal government regulators, but between regulators of different countries. Following the Banking Act of 1863, the next major event in U.S. banking history occurred in 1933, in the midst of the Great Depression. From 1929 to 1933, more than a third of all U.S. banks failed. Individual depositors lost $1.5 billion, or about 3% of total bank deposits. Millions of small savers lost their life savings. To protect depositories and make banks safer, Congress enacted the Glass-Steagall Act of 1933, which created the Federal Deposit Insurance Corporation, FDIC, and severely limited the activities of commercial banks. The FDIC proved insurance to individual depositories, so they would not lose their savings in the event that a bank failed. The act also restricted bank assets to certain approved forms of debt and forbade banks from dealing in securities, providing insurance, or engaging in any other activity undertaken by non-depository institutions. By separating commercial banks from investment banking, the law limited the ability of financial institutions to take advantage of economies of scale and scope that might exist in various lines of business. Nevertheless, this restriction on banks' activities remained in place until 1999, when the Graham-Leach-Bliley Financial Service Modernization Act repealed the Glass-Steagall Act. We will return to this topic shortly. The repeal of the Glass-Steagall Act in 1999 eliminated the restrictions on banks' activities, but it renewed concerns about potential mismanagement of large financial holding companies. The financial crisis of 2007 to 2009 underscored those concerns and led to the biggest financial reform since the Great Depression. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, Dodd-Frank aims to prevent financial crises and new government bailouts of financial intermediaries. In more than 800 pages of complex legislation, it sets out new rules for financial institutions and markets, requires a closer government oversight over key establishments, and called systematically important financial institutions, or SIFIs, regardless of their legal form, and sharply alters the authorities of the government agencies that govern the financial system. Like Glass-Steagall, the Volcker Rule, as part of Dodd-Frank, named after the former Federal Reserve Chairman who advocated it, also forbids insured depositories from taking proprietary trading, segmenting this and other business activities so that deposits insurance cannot subsidize bank risk-taking. We will explore the Dodd-Frank Act and its implications in some depth in Chapter 14. But it's already clear that Dodd-Frank and the hundreds of rules and procedures that the government is still developing to implement it will continue to change the financial landscape significantly in coming years. Much like the reforms of 1930s did the time, what remains unclear is how successful it will be in preventing another financial crisis. Competition and consolidation. None of the historical events we have discussed explains why there are nearly 5,300 commercial banks in the United States as of early 2016, or why that number had been shrinking since the mid-1980s. To unravel the mystery, let's return to figure 13.1. Notice the division between banks with branches and banks that don't have branches. As we mentioned in the introduction, banks that do not have branches are called unit banks. The alternative, which is familiar to most of us today, is a bank with many branches spread over the wide geographic area. Large banks like the Big Four, Bank of America, Citibank, J.P. Morgan Chase, and Wells Fargo, maintain branches in many cities across the United States and foreign countries. We'll return to these banks in a moment. For now, notice from the figure that in 1935, the vast majority of banks had no branches. Today, nearly 3/4 of them do. In fact, if we look at the numbers, we see that in 1935, there were 14,123 commercial banks in the United States, with a total of 17,237 offices. As of the first quarter of 2016, there were fewer than 5,300 banks, but they had nearly 90,000 offices. Today's banks not only have branches, they have lots of them. The number of banks and bank branches in the United States tells only part of the story. We also need to look at bank size. Table 13.1 shows that the U.S. banking system is composed of a large number of very small banks and a small number of very large ones. Roughly 1% of the banks hold more than 75% of all bank assets. In fact, the Big Four alone account for roughly 1/2 of assets in the U.S. commercial banking system. You're going to want to finish this reading on your own. After finishing the reading, watch a video called Banking on Change, Gonda's Savings and Loan Project. Then read an external page called Banking Forecast, Earnings Head Up. Then read a reading called Discussion, Can You Bank on It? Then there's flashcards to review. This concludes Objective 2. For Objective 3, we're starting on page 340. Non-depository institutions. A survey of the financial industry reveals a broad array of intermediaries. Besides depository institutions, there are 5 major categories of non-depository institution: insurance companies, pension funds, security firms, including brokers, mutual fund companies, and investment banks, finance companies, and government-censored enterprises. This classification is neither exhaustive nor meant to imply that an institution's activities are restricted to a particular category. Non-depository institutions also include an assortment of alternative intermediaries, such as payday loan centers. See Chapter 12, Your Financial World, The Cost of Payday Loans, page 309. Rent-to-own centers, peer-to-peer lending firms, pawn shops, and even loan sharks. Table 13.3 shows that depository institutions accounted for only 1/4 of the nearly $70 trillion in assets held by financial intermediaries in 2015. In the decades after 1970, the share of intermediation handled by banks fell steadily until the crisis of 2007 to 2009, temporarily depressing the assets of many non-banks, but the relative decline of depositories subsequently resumed. Insurance companies suffered a similar fate as their share of intermediation fell from 18.5% in 1970 to 11.5% in 2015. Meanwhile, mutual funds have been the big winners, growing from a 3.5% share in 1970 to more than 25% by 2015. Pension funds increased in importance, as well as rising from 12.5% of all assets in 1970 to more than 25% over the 45-year period. Our goal in this section is to understand the role of each of these types of non-depository institution in our financial system. We will do so by focusing on the functions of each. Recall from Chapter 11 that the functions of financial institutions can be divided into 5 categories. 1. Pooling the resources of small savers. 2. Providing safekeeping and accounting services, which allow people to make payments and track their assets. 3. Supplying liquidity by converting resources into means of payment whenever needed. 4. Providing diversification services. And 5, collecting the processing information in order to reduce information costs. We will use the same system to classify non-depository institutions. Insurance companies. Insurance companies began with long sea voyages. Centuries ago, distance trade and exploration were fraught with risk, and that risk generated a demand for insurance. Modern forms of insurance can be traced back to around 1400, when wool merchants insured their overload shipments from London to Italy for 12 to 15% of their value. Overseas shipments were even more expensive to insure. The first insurance codes were developed in Florence in 1523. They specified the standard provisions for a general insurance policy, such as the beginning and end of the coverage period, and the time frame for the receipt of payment following a loss. They also stipulated procedures for handling fraudulent claims in an attempt to reduce the moral hazard problem. In 1688, Lloyd's of London was established. Today, Lloyd's is famous for insuring singers' voices, dancers' legs, and even food critics' taste buds, as well as more traditional assets like airplanes and ships. The best-known insurance company in the world, Lloyd's began in a small London coffee house whose proprietor, Edward Lloyd, catered to retired sea captains who had prospered in the East Indies spice trade. Having sailed many of the trade routes themselves, these captains possessed special knowledge of the hazards of sea voyage. They used their knowledge to assess the risk associated with particular routes and to dabble in marine insurance. The risks were not inconsequential. In the 17th century, a typical voyage to the Spice Islands, part of Indonesia, and back lasted 3 years. Only 1 in 3 ships returned with its cargo, and as few as 1 in 8 sailors lived to tell the tale of adventure. The rewards of a successful voyage were coveted in spices like nutmeg, a single sack of which could make the sea captain wealthy for the rest of his life. Your financial world. Why you are obliged to buy health insurance. In its landmark 2015 decision upholding the Affordable Care Act, ACA, also known as Obamacare, the U.S. Supreme Court explained why health insurance that is always available to everyone at a common price requires a mandatory element. Why buy insurance when you are healthy if you can buy the same coverage at the same price when you are ill? The justices went on to describe how such adverse selection can trigger a death spiral for health insurance programs. To see what they meant, suppose that an insurer initially bases the policy premium on the nation's average cost of healthcare per person. If participation is voluntary, healthier people, typically young adults, will be less willing to enroll than those who anticipate greater than usual health care costs. Consequently, insurance outlays will exceed the norm, leading to losses for the insurance firm. If the insurer then raises the premium, the relatively healthy will drop their insurance. The higher the premium, the smaller the enrollment, and the worse the health of those still insured. Eventually, the program becomes unviable. The adverse selection problem can be addressed in one of 2 ways. 1, allow price discrimination based on health status, or 2, make insurance mandatory. Under the first option, allowing insurers to set premiums according to the health of the applicant, the way that they do for life insurance, makes the system workable. The more healthy person, the lower the premium. The low premium reduces the incentive to drop out. But concerns about fairness often lead governments to forbid this kind of price discrimination. Poor health is usually a result of poor fortune, and is precisely bad luck against which people need insurance. Consequently, in most advanced economies, the solution to the adverse selection problem is the second option, compel participation. How was adverse selection managed in the United States before the passage of the ACA? For the most part, employers who paid health insurance promised insurers broad participation, limiting the risk that healthy workers would drop out. However, the health insurance system had major shortcomings. For example, an estimated 47 million U.S. residents, about 18% of the population, went uninsured before the ACA was introduced. In addition, persons with pre-existing conditions could not obtain new coverage, so many stayed in their jobs, even when that was insufficient, just to keep their health insurance. The science of genomics is adding to the problem of adverse selection. Advances in DNA testing are making it more feasible to anticipate the individual's future illnesses, another reason why health insurance will be broadly available at a common price only if it's mandatory. To obtain insurance, a ship's owner could write the details of a proposed voyage on a piece of paper, together with the amount he was willing to pay for the service, and then circulate the paper among the patrons at Edward Lloyd's coffee house. Interested individuals will decide how much of a risk to accept and then sign their names under the description of the voyage. This customary way of doing business became the source of the term underwriter. Underwriter was open to anyone who wished to assume the risk associated with sea voyages. Because Lloyd's predated by several centuries the concept of limited liability, in which investors' losses were confined to the amount of their investment, underwriting implied unlimited liability. The saying was that an underwriter was liable down to his last cufflink. Today, Lloyd's provides insurance through a more conventional structure of limited liability company. The losses of individual investors in a syndicate are limited to the amount of their initial investment, and no person is exposed to the possibility of financial ruin. Two types of insurance. At their most basic level, all insurance companies operate like Lloyd's of London. They accept premiums from policyholders in exchange for the promise of compensation if certain events occur. A homeowner pays a premium in return for the promise that if the house burns down, the insurance company will pay to rebuild it. For the individual policyholder, then, insurance is a way to transfer risk. In terms of the financial system as a whole, insurance companies specialize in 3 of the 5 functions performed by the intermediaries. They pool small premiums and make large investments with them. They diversify risk across a large population, and they screen and monitor policyholders to mitigate the problem of asymmetric information. Insurance companies offer 2 types of insurance: life insurance and property and casualty insurance. Life insurance companies like Prudential of America, Metropolitan Life, and John Hancock Mutual Life sell policies that protect insured against the loss of earnings from disability, retirement, or death. Property and casualty companies sell policies that protect households and businesses from losses arising from accident, fire, and natural disaster. Both types of intermediary allow individuals to transfer their risks to a group. While a single company may provide both kinds of insurance, the 2 businesses operate very differently. Life insurance comes in 2 basic forms, called term and whole life insurance, as well as a variety of hybrids. Term life insurance provides a payment to the policyholder's beneficiaries in the event of the insured death at any time during the policy's term. The premium depends on the very predictable proportion of people of a given age who will die. Term policies are generally renewable every year or so, as the policyholder is less than 65 years old. Many people obtain life insurance through their employees, and arranged called group life insurance. You're going to want to finish the rest of this reading on your own. After the reading, read an external page called How to Spot a Bad Mutual Fund. Then read a different external page called Chinese Embrace Massive Life Insurance Policies. Then read another external page called Regulation of Non-Depository Banks. And lastly, there's some flashcards to review. This concludes Objective 3, and this concludes Unit 5.